What happens when one market is screaming, "I need metal now," while another market is still pricing silver like it's just a chart? Silver didn't just rally, it ripped higher, then snapped back. Because this isn't normal price discovery anymore. This is pressure. The kind of pressure that builds quietly in supply chains, then shows up all at once on a price screen. Now add the second signal. Shanghai trading silver at a premium over London. That's not a trivia stat. That's a siren. Because when the premium gets big enough, it stops being a difference. It becomes a map. A map showing where the metal wants to go. And that's how you get a headline like, China paying $126. Not as a clean global spot price, more like a blended, scarcity-driven number people throw around when physical delivery, local premiums, product form, taxes, financing, and urgency stack into one ugly total. The number isn't the story. The gap is the story. Because gaps create predators. And the predator in metals is arbitrage. But to understand why this feels like war, you have to understand what silver really is. For most of human history, silver wasn't a commodity. It was the receipt, the proof, the one thing you could hold in your hand and know, without trust, without permission, that you could trade it for food, labor, protection. Empires rose when silver flowed in. Empires cracked when silver flowed out. The old world ran on metal the way the modern world runs on electricity, invisible until it disappears, and then suddenly nothing works. Then we built a more convenient kind of power, paper promises. For a while, it looked like magic. Money became numbers, not weight. Nations could finance wars, rebuild cities, stabilize banks, smooth recessions. But every system built on trust has a hidden cost. The more you rely on belief, the more catastrophic it gets when belief starts to fail. And in the mid-2000s, trust hasn't been failing quietly. It's been failing in stereo. Governments borrow like tomorrow is optional. Central banks flinch between inflation fear and recession fear. Markets binge narratives that change every week. But the physical world doesn't care about narratives. Factories don't run on opinions. Grids don't run on vibes. Ports don't unload confidence. Mines don't ship sentiment. They ship inputs. And that's where silver walks back onto the board like a piece people forgot was armed. Because silver isn't just a store of value. It's a working metal. It's in electronics, industrial equipment, and the contacts and conductors that keep modern life humming. And when economies electrify, when solar, data centers, and advanced manufacturing scale up, silver stops being a nice-to-have. It becomes a choke point. Now picture the collision. Two forces hit the same metal at the same time. Investors stampede into hard assets. And industry pulls the same material into production lines. That's how you get a market that doesn't just rise, it snaps. Now here's where this stops being a market story and turns into a geopolitical thriller. Because silver doesn't trade in one place. It trades in arenas. New York, London, Shanghai. Different rules, different liquidity, different ways of defining what silver even means. On one side, you have paper claims, futures contracts, unallocated accounts, synthetic exposure. On the other side, you have physical bars, serial numbers, vault receipts, delivery schedules, and shipping manifests. And when the paper price and physical reality drift apart, the predator wakes up. Arbitrage. Arbitrage is brutally simple. Buy where it's cheap, sell where it's expensive. But in metals, simple has sharp edges. You can't scoop up 1,000,000 ounces, toss it in a backpack, and teleport it to the highest bidder. Purity specs, bar sizes, assay rules, warehouse approvals, export paperwork, insurance, financing costs, and time. Time is the killer. So for arbitrage to explode, the price gap has to get wide enough to swallow all those costs and still leave profit. That's why China paying $126 spreads like gasoline fumes. Because if one market is paying a premium big enough to cover the whole ugly chain, then the trade stops being theoretical. People don't just trade contracts, they start pulling metal. And that's when vaults become battlefields. Not with soldiers, with spreadsheets. Inventory gets reclassified, lease rates jump, refiners get booked out. The market starts sounding different, less like finance, more like logistics. And the Shanghai premium is the loudest sound in the room. Because a premium is a confession. It's a market admitting, out loud, paper won't help me, I need the real thing. So, why would China pay up? Why would anyone pay up? Because metals aren't just investments, they're insurance policies on supply chains. Now, zoom out, because silver is only half the chessboard. The other half is the stuff most people can't name, but every great power fears: rare earths. Rare earth elements are a cruel joke in language. They're not rare in the ground. What's rare is the ability to process them at scale, cheaply, consistently, and without political hesitation. Refining is complex. The supply chain is harsh. The know-how, especially for high-performance magnets, is uneven. And that's where power hides. Not in the ore, in the refinery. Because rare earth magnets are the muscle of the modern machine. EV motors, wind turbines, precision systems, defense platforms. They're the difference between we have a plan and we can actually build it. So when tensions rise, rare earths don't behave like a normal commodity. They behave like leverage. You've seen this movie before. A single diplomatic clash can expose how fragile dependency really is. Once that lesson lands, it doesn't fade. Governments start talking about diversification, stockpiles, friendshoring. But physics doesn't care about talking. Supply chains keep pulling gravity toward whoever can refine, manufacture, and ship at scale. Then the lesson grows teeth. Controls escalate from rumor to mechanism. Licenses, lists, restrictions, carve-outs. And when that's the game, the responses stop being polite. They become frantic. Japan is a perfect example of what frantic looks like when the stakes turn national. It launched a deep-sea expedition to extract rare earth minerals from seabed mud near Minamitori Island, part of a long campaign to cut dependence on China and build a more domestic, diversified supply. Read that again. A major industrial power is sending a ship to pull minerals from nearly 6 kilometers underwater because the supply chain has become a geopolitical chokehold. That's not a market, that's mobilization. So connect the dots. When rare earths become leverage, everyone scrambles to reduce dependence. New mines? Years. New refineries? Years. Stockpiles, strategic reserves, emergency procurement, long-term offtake deals. All of it increases appetite for physical commodities, things you can warehouse, count, and control. That's the same psychological shift that drives silver surges. When trust gets fragile, power moves toward tangible control. And it doesn't stop at rare earths. Critical minerals metastasize into everything: lithium, nickel, cobalt, graphite, copper, uranium, each with bottlenecks and political fault lines. One country dominates processing, another dominates mining, another dominates equipment, another dominates shipping insurance, another dominates the currency used to settle trade. Which brings us to the most dangerous layer of all: money. Because every resource war is also a settlement war. What currency clears the deal? What rails move the payment? What sanctions risk haunts the transaction? What jurisdiction can freeze assets? When currency becomes political, commodities become strategic. When commodities become strategic, price stops being just price. It becomes a signal of sovereignty. So if you want the heartbeat of World War Silver, it's this. A fractured world produces fractured markets. One market says silver is X. Another says it's X plus a premium that screams urgency. A third doesn't care what your screen says. It asks one question: can you deliver next week? Then traders show up. Logistics firms show up. Refiners show up. Financiers show up. And in the middle of all of it, the system remembers an uncomfortable truth. You can print claims faster than you can mine metal. That's why this gets vicious. Great powers don't lose sleep over volatility. They lose sleep over dependency. over the idea that, in a crisis, someone else can turn a knob and your factories go dark. So the contest becomes relentless. Subsidies here, controls there, strategic stockpiles, quiet deals, sudden regulations, and always, the race to secure the next shipment before the other side does. Now go back to the hook. China paying $126. If a major buyer is willing to pay above the global benchmark, and if the gap is big enough, metal starts moving like it's being drafted into service. And that's what makes this feel like war. Not because someone fired a shot, because behind the scenes, nations are doing the peacetime equivalent of mobilization, locking down supply, reshoring capacity, weaponizing regulation, building reserves, and probing each other's weak points in the global production web. Silver is the headline because it's visible, emotional, and tradable. Rare earths are the silent driver because they're embedded inside machines that decide economic advantage. Currency and settlement are the shadow layer because they decide who can pay, who can clear, and who can be cut off. And once you see it, the scariest part isn't any single spike. It's the loop. Fear causes hoarding. Hoarding causes shortages. Shortages trigger governments. Governments fracture markets. Fractured markets widen arbitrage. Widened arbitrage pulls physical inventory. And once inventory becomes the prize, every vault, refinery, and port turns into a strategic asset. So if you're watching this thinking, okay, but what happens next? Here's the cliffhanger. In a fractured commodity world, the real question isn't what's the price. It's who sets the price that matters. The paper market, or the buyer who can't keep the lights on without the metal. And if the answer keeps shifting from screens to ships, from contracts to cargo, this isn't the end of a bull market. It's the beginning of a resource war. Because in the new era, the richest country isn't the one with the most money. It's the one with the most inputs, things nobody can replace on short notice. And that's why silver and rare earths aren't investing topics. They're geopolitical weapons, wrapped in commodity tickers, moving through a supply chain that's starting to look a lot like a front line.